Welcome to the Pro Ticker Deep Dive.
It's great to be here.
We are absolutely thrilled to have you, the listener, with us today because if you are someone who keeps even half an eye on your retirement portfolio,
All right.
or if you just casually follow the broader global economy, you already know that the financial landscape we're standing in right now in early 2026 has been, well, it's been nothing short of a roller coaster.
Yeah, but honestly, roller coaster implies you end up back where you started, perfectly safe.
That is a very good point. What we've experienced is more like a financial stress test of just unprecedented scale.
Absolutely.
So we want to welcome you to a comprehensive, really a no stone unturned exploration of what is genuinely happening under the hood of the global markets right now.
Yeah.
We are looking specifically at the massive tectonic shifts happening at the intersection of cryptocurrency and traditional Wall Street equity markets.
What is where all the action is.
Exactly. So just to set the scene for you. Between late 2025 and February of 2026, the global financial world watched in absolute awe as we hit these breathtaking market highs. I mean, we saw the premier digital asset peak at over $125,000 per
I
coin.
felt completely euphoric at the time.
It did. And then, almost immediately, we witnessed this violent, relentless, algorithmic crash that pulled it all the way down below $70,000 by February 2026.
Yeah.
Over $500 billion of value, completely vaporized in a matter of weeks.
Just gone.
Gone. So the mission of this deep dive today is to unpack the underlying granular mechanics of that crash. We're going to dismantle the enduring myths surrounding safe haven assets.
Right.
And we're going to explore a completely new reality, a reality where digital assets are no longer this rebellious outsider technology, but are now fully integrated and heavily entangled with the traditional plumbing of Wall Street.
Okay.
Let's unpack this.
That is really the perfect foundation to start on. Because to truly understand the sheer velocity of what happened in February 2026, we have to first step back and recognize a fundamental, irreversible shift in the market's underlying structure.
Right.
For the better part of a decade, the narrative driving this entire asset class was deeply, almost fiercely ideological.
The whole HODL culture.
Exactly, the HODL culture.
Yeah.
It was driven by retail investors, everyday people who were holding on for dear life, buying the dip, regardless of what the broader macroeconomic weather looked like.
Sure.
But what the hard data from the last couple of years unequivocally demonstrates is that the market has fundamentally transitioned. We have officially moved away from a market defined by ideological holding.
And move to what?
We've entered a state of algorithmic institutional reflexivity. The asset is no longer sitting outside the gates of the traditional financial system. It has been invited inside, given a desk, and plugged directly into the mainframe.
What?
And because it is now deeply embedded within institutional balance sheets, it behaves exactly the way Wall Street's emotionless risk models dictate it should. If we want to understand the crash, we have to set aside the popular internet narratives and look calmly and analytically at the actual market microstructure. Because the numbers tell a story that is vastly different from the headlines.
I think that's where we need to start making some serious distinctions. Let's just dive right into the deepest end of the pool and tackle the biggest narrative of them all.
Digital gold.
Exactly. The idea of digital gold. If you, the listener, have spent any time reading about this space over the last 5 years, you know the prevailing thesis.
Oh, absolutely.
The story went like this. Because this specific asset has a strictly fixed supply cap of exactly 21 million coins, it was mathematically engineered to be the ultimate hedge against fiat inflation.
Right. The pitch was that it would act as an impenetrable safe haven during market panics.
Yes. The promise was that you buy it, you lock it away, and when the traditional stock market inevitably catches fire, your digital vault remains totally secure, perfectly insulated from the chaos.
Yeah.
But when we actually look at the hard numbers from the 2020 to 2026 period, that whole safe haven story completely falls apart, doesn't it?
It falls apart spectacularly. When we run a comprehensive analysis of the daily trading observations spanning multiple distinct macroeconomic regimes.
Like the pandemic.
Right. Starting from the massive central bank liquidity surges during the 2020 pandemic, all the way through the brutal interest rate tightening cycles of 2022 and 2023, and finally into this post-2024 era of massive institutional ETF adoption.
The dual nature of it.
Exactly. The dual nature of the asset becomes glaringly obvious. On one side of the ledger, Yes, the asset has delivered absolutely exceptional annualized returns, historically hovering around that 61% mark for the better part of the decade.
Which is undeniable wealth generation.
It is.
Ah.
But, as any portfolio manager will tell you, raw return is only half of the equation.
Right.
The other half is risk, and more specifically, the actual distribution of that risk. The statistical data shows that this asset has an incredibly heavy-tailed risk distribution. In strict econometric terms, it exhibits a kurtosis of over 400.
Wait, hold on. A kurtosis of over 400.
Yes.
Let's pause right there and translate that math for me and for the listener. Because I know from my college statistics class that a standard bell curve is nowhere near that number.
Not even close.
What does a 400 actually look like in the real world of trading?
That's a great point of clarification. Think of a perfectly normal distribution of risk. Your classic bell curve, where most trading days are pretty average and extreme events are incredibly rare.
Okay.
A standard normal distribution has a kurtosis of exactly 3.
3.
Yes, 3. So when I say an asset has a kurtosis of over 400, I want you to visualize that bell curve being squeezed aggressively from the sides,
Right.
pushing a massive amount of probability out into the extreme far edges, the tails of the curve. A number that high means this asset is highly, almost uniquely prone to extreme catastrophic downside shocks.
Wow.
Those rare black swan-style drop-offs aren't actually rare anomalies in this market. They are a defining, mathematically undeniable feature of the asset itself. It's not a safe haven. It is a hypervolatile, pro-cyclical risk asset.
That is a staggering visual. Basically, instead of a gentle hill where you can safely roll down, it's a sheer cliff face.
Precisely.
It means those catastrophic drop-offs are just part of the entry ticket. And this brings us to a concept that I think really exposes the flaw in the defensive portfolio strategy, the beta divergence.
Yes.
Can you explain what beta means in this context? Because I feel like this completely torpedoes the idea that you can use this asset to protect your 401k.
Absolutely. Beta is essentially the financial metric we use to measure an asset's sensitivity to the broader market, typically represented by a major index like the S&P 500. If an asset has a beta of exactly 1.0, it moves perfectly in tandem with the stock market. If the S&P drops 5%, the asset drops 5%.
Got it.
If an asset has a beta of 0.5, it is half as volatile, making it somewhat defensive. Now, if you look at the broad, sweeping data during normal, everyday trading conditions over the last few years, the correlation between this digital asset and the S&P 500 might seem somewhat moderate.
So people look at that and think it's safe.
Right. You might look at a standard regression model, average everything out, and conclude that it offers decent portfolio diversification. But standard models are dangerous because they average out the normal sunny days with the horrific crash days.
Oh.
When we apply what's known as a quantile regression framework, meaning we filter out all the normal days and look exclusively at the 10th quantile, which represents the absolute worst 10% of trading days, the days of sheer, unadulterated market panic.
What happened?
The true underlying behavior of the asset is exposed. During those specific crash events, the asset's beta doesn't just stay moderate. It violently spikes to 1.25.
Wait, so you're saying it doesn't just fall with the market?
No.
It falls significantly harder. It moves faster and more aggressively than the broader stock market in the exact same downward direction.
Precisely. When traditional equities are plunging and you need a safety net the most, this asset doesn't catch your fall. It actively accelerates it.
Yay.
It drops 25% harder than the broader market you were hoping it would protect you from. And to really highlight how much of a departure this is from the digital gold narrative, we need to contrast this behavior with actual physical gold.
Okay, let's look at real gold.
During those exact same periods of extreme market stress, those 10th quantile days, physical gold maintains a crash beta of just 0.097. Wow. That means gold is effectively decoupled from the panic in the equity markets. It barely registers the shockwaves. We saw this play out in real time, in the real world, in August of 2025, and again during the massive liquidation cascade of February 2026.
Right.
While digital assets were plunging violently right alongside over-leveraged tech stocks, traditional physical gold either held its ground perfectly or actually caught a bid and rallied.
That is a phenomenal comparison. It's like owning a mirror that shakes 25% harder than the object it's supposed to be reflecting.
That's a great way to put it.
That is an absolutely terrifying prospect if you are a passive investor holding it as a defensive position. But let me play devil's advocate for a second, because I know there is a very specific historical event that people always bring up to defend the safe haven theory.
I know exactly which one you mean.
March 2023. The Silicon Valley Bank collapse. I remember that week vividly. The traditional stock market was reeling. Regional banking stocks were in an absolute free fall. People were panicking about payrolls. But digital assets rallied aggressively. Didn't the asset prove, beyond a shadow of a doubt, that it acts like a safe haven during a banking crisis?
It's a very common pushback.
Yeah.
But the SVB collapse is quite literally the exception that proves the rule.
How so?
Yes, digital assets rallied forcefully during that specific narrow window of time, but we have to be incredibly precise about why they rallied. The SVB collapse was a very specific type of crisis. It was a crisis of confidence in the underlying plumbing of the traditional fiat banking system itself.
Right. People were terrified of their bank failing.
Exactly. Investors and venture capitalists were specifically fleeing regional banks because they suddenly feared direct counterparty risk and the terrifying prospect of uninsured deposit confiscation.
Makes sense.
In a crisis that is explicitly targeted at the mechanical failures of fractional reserve fiat banking, a bearer asset that is completely decentralized and operates outside that fiat system suddenly looks incredibly attractive. It acted as a hedge against a banking failure. However, the macro environment and the crash of early 2026 are fundamentally different beasts. 2026 was not a crisis of confidence in banks. It was a broad liquidity and leverage crisis across the entire financial spectrum.
A liquidity desert.
Yes, and the cardinal rule of finance is that when broad liquidity rapidly drains from the global financial system, highly speculative, high-beta assets are the very first things to be mercilessly liquidated to raise cash.
I see. So it's about identifying the actual disease.
Exactly.
In 2023, the disease was localized to the banks, so people fled to the non-bank asset.
Yeah.
In 2026, the disease was a total evaporation of liquidity everywhere. And in liquidity desert, people don't buy volatile assets, they sell them to survive.
Right.
So if we can definitively say it is not digital gold, what are we actually dealing with here? We need a completely new framework, a new vocabulary for this. The data heavily suggests we should retire the term digital gold entirely. The more accurate term would be digital alpha.
I completely agree.
It is essentially a hypercharged, high-conviction bet on the expansion of global liquidity and overall technology adoption. It functions as a pro-cyclical volatility multiplier. Let me just pose this thought to you, the listener, right now.
Yeah.
Have you been sitting there, looking at your portfolio, treating your high-risk digital assets as a safety net against a coming recession? Because if you have, the cold, hard empirical data from the last 6 years is screaming a warning at you. You aren't mitigating your risk, you are actually accelerating it.
That is precisely the crucial takeaway for any institutional portfolio allocator or retail investor alike. There was this widespread assumption that the massive wave of institutionalization we saw, the billions of dollars flowing from Wall Street, would magically endow the asset with stabilizing safe haven properties.
People thought the suits would bring calm to the casino.
They did, but the exact opposite happened. As the asset entered diversified, multi-trillion-dollar institutional portfolios, it stopped being managed by ideological believers. Instead, it became managed by sophisticated risk parity models and algorithmic trading bots that are explicitly programmed to treat it as a high-beta risk asset. It is undeniably a powerful diversifier for a growth-oriented portfolio when liquidity is expanding. But it objectively fails every essential mathematical criterion required to be classified as a sovereign-grade hedge or a store of value during a liquidity contraction.
Okay, so we've laid out the theoretical framework and the math. Now let's move from the spreadsheets to the actual blood in the streets. Let's really dissect the anatomy of that February 2026 liquidation cascade.
That's good.
Because this wasn't just a minor technical pullback or a healthy market correction. This was a bloodbath.
It was.
We saw a massive forced $19 billion unwind start back in October 2025, which looking back was clearly the tremor before the earthquake.
Absolutely.
And then the actual February 2026 crash hit, and it wiped out nearly $500 billion in total crypto market value in the blink of an eye. $500 billion just evaporated from the global ledger.
Unbelievable scale.
What were the specific structural Wall Street drivers that conspired to cause a collapse of that magnitude?
The collapse wasn't a random panic. It was a highly orchestrated, albeit chaotic, unwinding of leverage. It was the perfect storm of institutional mechanics failing simultaneously.
Right.
If we want to dissect the anatomy of the crash, we have to look at four primary drivers.
Okay, what are they?
The sudden collapse of what's known as the basis trade, the aggressive institutional deleveraging across traditional equity portfolios, the direct contagion spreading from the tech stock sector, and finally, the devastating negative feedback loop caused by massive ETF outflows.
So all four hitting at once.
Yes. To really understand the sheer scale of the selling pressure, we have to spend some time breaking down the basis trade, because this was the hidden engine driving massive amounts of Wall Street capital into the space throughout 2024 and 2025.
Right.
For a long time, elite hedge funds were extracting massive and what they believed to be essentially risk-free yield from this market.
Let's actually pause and explain that. Walk me through the mechanics of the basis trade, like I'm a first-year analyst on a trading desk.
Sure.
How exactly were these hedge funds generating these massive yields? Because I remember hearing numbers like 15%, 16%, even 17% annualized returns on a supposedly market-neutral trade. How does that actually work?
It's a brilliant piece of financial engineering when the market conditions are right. The trade relies on a market condition called contango.
Contango.
Yes. In a bullish speculative market, which digital assets were in for quite some time, the price of a futures contract, which is a promise to buy the asset at a later date, trades at a significant premium to the spot price being the price of the asset right this very second.
So the future price is higher than the current price.
Exactly. Speculators were willing to pay a massive premium for leverage in the futures market. So hedge funds saw an arbitrage opportunity. They would execute a very simple two-legged trade. They would buy the spot asset, which became incredibly easy and frictionless to do once the spot ETFs were approved.
Right.
And at the exact same millisecond, they would sell or short the futures contracts. By doing this, they perfectly hedged their price risk.
Because they own it and are betting against it at the same time?
Perfectly stated. It didn't matter if the price of the asset went up 50% or down 50%. They were completely insulated. All they were doing was patiently sitting there and pocketing the massive spread, the premium between the spot price they paid and the futures price they sold.
So as long as the market was wildly speculative and people were overpaying for futures, it was essentially free money for Wall Street.
Yes.
They were just picking up massive yield without taking on directional risk of the asset itself. But I'm guessing the golden goose didn't live forever.
Exactly. Market dynamics shift, and arbitrage opportunities are eventually arbitraged away by sheer competition. By late 2025 and into early 2026, the rampant speculation cooled, the premium collapsed, and that incredibly lucrative 17% yield compressed drastically.
Down to what?
It fell all the way down to a meager 2.4%.
Oh, wow.
Now, let's put that in the broader macroeconomic context. You have to compare that 2.4% yield to the risk-free Treasury bill rate at the time. Because of the central bank policies, a completely risk-free, guaranteed U.S. government T-bill was yielding around 4.5%.
So almost double.
Exactly. So put yourself in the shoes of a hedge fund manager. Your complex, computationally heavy, exchange risk-laden crypto arbitrage is now only yielding 2.4%. Meanwhile, you can call up your broker, buy a U.S. Treasury, do absolutely zero work, take on zero counterparty risk, and get a guaranteed 4.5%. What is your logical, mathematical, fiduciary duty to your investors?
It's a no-brainer. You unwind the trade immediately, you take your money out of the complex crypto plumbing, and you park it in treasuries.
Exactly.
But unwinding that trade isn't just flipping a switch, is it? To unwind it, you have to close out your future short, and crucially, you have to sell the spot asset that you are holding as the hedge.
Spot on.
And because so many of these funds were using the newly approved ETFs to hold that spot asset, unwinding the trade meant hitting the ETFs with massive redemption requests. Here's where it gets really interesting.
Right.
For years, the approval of the spot ETFs was championed as the holy grail for this industry. They were celebrated as the ultimate legitimizer.
Yeah.
The bridge that would bring trillions of dollars of sticky, long-term, diamond-handed capital into the space.
That was the narrative.
But instead, the ETFs functioned as a two-way street, and on the way down, they created a ruthless, self-reinforcing downward spiral. Can you walk us through step by step how that ETF feedback loop actually functions in real time during a panic?
It is a critical piece of the puzzle. If we connect this to the bigger picture of market microstructure, We realized that the ETF era introduced complex mechanical realities that simply did not exist in any of the prior crypto bear markets.
Right.
Back in 2018 or 2022, if people wanted to sell, they had to navigate clunky exchanges. Now it's institutional and automated. When these massive hedge funds decide to unwind their basis trades, they go to the ETF issuers and redeem their shares.
Okay.
The ETF issuer, usually acting through an authorized participant, must then go into the underlying open market and sell the actual digital coins to raise the fiat cash to pay back the hedge fund.
So, forced selling.
Yes, these massive multi-million-dollar institutional outflows directly drain liquidity from the underlying exchange order books. As the selling pressure ramps up, the market makers step back and liquidity thins out dramatically. In fact, our data shows that exchange order book depth dropped by a staggering 65% during this specific period in February.
And when order books are that thin, a sell order that normally would barely move the needle suddenly crashes through multiple price levels.
Exactly. Any subsequent selling pressure has a massively outsized, violent impact on the price. The price drops sharply. And in the highly leveraged world of digital assets, a sharp price drop instantly triggers automated risk management algorithms and forced liquidations in the offshore derivatives markets.
A cascade.
Exactly. Those forced liquidations result in massive, indiscriminate market sell orders, which drops the price even further. That sudden, terrifying plunge on the charts then spooks the retail investors and the momentum-based institutional holders.
So they hit sell, too.
Right. They hit the sell button on their brokerage apps, which leads to more ETF redemptions, which forces the ETF issuers to dump more spot assets onto the thin order books. It becomes a purely mechanical, completely emotionless cycle of forced selling.
It's quite literally a machine eating itself. The algorithms take over and human sentiment becomes completely irrelevant.
Completely irrelevant.
But what's really wild to me about the February 2026 crash is that the primary trigger that set off the worst of the ETF redemptions wasn't even necessarily a flaw or a scandal within the digital asset ecosystem itself.
No, it wasn't.
It wasn't an exchange blowing up or a protocol getting hacked.
Yeah.
A massive part of this crash was purely the result of Wall Street reflexivity. Let's talk about what was happening in the traditional stock market that week.
The tech wreck.
Exactly. We saw mega-cap tech stocks absolutely hemorrhage value. Microsoft dropped something like 10% in a matter of days. AMD plummeted 17%.
It was severe.
The market was suddenly gripped by what analysts were calling CapEx sticker shock. This sudden, terrifying realization that the infrastructure costs to build out artificial intelligence data centers were vastly outpacing the near-term revenue.
Right.
Traditional portfolio managers suddenly woke up, looked at their screens, and found themselves staring down the barrel of massive, multi-billion-dollar margin calls on their traditional tech equity books.
Precisely. And this is where the entanglement narrative becomes undeniable reality. When a traditional portfolio manager at a major desk faces a severe margin call, the rules of the game dictate immediate action.
They need cash.
Exactly. They do not have the luxury of selling what they want to sell. They must sell what they can sell. They rapidly scan across their entire multi-asset portfolio, looking for highly liquid assets that are either still sitting on decent historical gains or, at the very least, have deep enough 24/7 order books to absorb a massive block trade without slippage.
And digital assets fit that bill perfectly.
Exactly. They didn't wake up that Tuesday morning and dump their digital assets because they read a white paper and suddenly stopped believing in the ethos of decentralization or the transformative power of the blockchain. The philosophy was irrelevant.
Right.
They sold because the digital asset was a highly liquid, instantly settled asset class that could immediately generate the hard fiat cash they desperately needed to cover their hemorrhaging traditional equity losses.
Wow. So they literally used the crypto market as a liquidity backstop. The digital asset market was essentially treated as an ATM to bail out Wall Street's bad bets on AI chip makers.
That is exactly what the mechanics reveal. It was a liquidity proxy. And that reality completely flips the script on the decade-old narrative that this is an uncorrelated asset that protects you from traditional market turbulence. And we don't just have to guess that this was Wall Street doing the dumping. We have concrete, undeniable forensic proof that this specific wave of selling was driven by U.S. institutional desks.
It wasn't just retail panic.
No,
Yeah.
it was not just some generalized global retail panic.
Right. And the specific metric that proves this, which absolutely blew my mind when I saw the charts, was the Coinbase premium.
Yes.
Let's talk about that, because for a record 40 consecutive days during this crisis, the asset actually traded cheaper in the United States than it did on overseas exchanges. The premium went negative, incredibly negative, hitting a low of minus $167.80. Why is that specific number the smoking gun?
The Coinbase premium is a vital, irrefutable forensic tool for understanding the flow of capital in this ecosystem. Coinbase is universally recognized as the primary execution venue and custodian for U.S. institutional capital. The hedge funds, the asset managers, the authorized participants for the ETFs.
Right.
Conversely, the massive offshore exchanges, like Binance and others, handle a much larger percentage of the global retail flow and non-U.S. capital. Historically, U.S. institutions tend to drive price action, often paying a slight premium.
So usually it's positive.
Exactly. But when the asset is consistently trading at a significant discount on Coinbase for over a month straight, it sends an unambiguous signal to the market. It tells us unequivocally that U.S. institutions are the ones aggressively and relentlessly hitting the bid.
They were dumping.
They were the ones driving the price down, prioritizing execution speed over price optimization, dumping massive tranches of the asset, while the rest of the global market was frantically trying and failing to absorb the massive influx of supply.
So, knowing all of this, what does this actually mean for the culture of the market? Because I think anyone who has followed this space knows that for years, the defining ethos, the rallying cry of this entire community was the HODL mentality.
The diamond hands.
Yes, the diamond-handed ideological believers who loudly promised on social media to buy every single dip, to never capitulate, and to hold the asset until the traditional fiat system collapsed. Where are those people now?
The blunt reality is that that specific culture, while vibrant and historically important to the asset's early survival, has been financially engineered out of relevance when it comes to marginal price setting.
Wow.
The market's steering wheel has been handed over. It is no longer driven by the collective sentiment of ideological believers on internet forums. The daily marginal price action is now ruthlessly driven by risk parity models, macro correlation algorithms tracking the Nasdaq-Q, and portfolio managers who will instantly authorize a massive sell order when their internal risk auditors demand a reduction in portfolio volatility.
Or when that basis trade yield drops.
Exactly. Or when the yield on an arbitrage trade drops below a benchmark hurdle rate. There is absolutely no ideology in a basis trade. There is zero conviction or loyalty in a margin call.
So true.
The asset has matured, and the industry got exactly what it asked for: institutional adoption. But that maturity means it is now hopelessly subject to the cold, hard, unforgiving mathematics of traditional corporate finance.
So Wall Street is treating this asset as an ATM to cover their tech losses. But what happens when the entity holding the asset isn't a nimble hedge fund that can just quickly unwind a trade?
Right.
What if it's a massive publicly traded corporate entity that physically can't pivot? Let's talk about the corporate treasury trap, because nobody represents the spectacular collision of traditional corporate finance and digital assets, quite like the public companies that have transformed themselves into massive treasury vaults.
This is a crucial point.
We have to look at the absolute biggest player in this specific arena, formerly known to the world as MicroStrategy. They famously rebranded to simply Strategy in 2025 to reflect their total, uncompromising commitment to accumulating this single asset.
Yes.
As we look at their filings in early 2026, this single publicly traded company holds roughly 714,000 coins. Their average cost basis across all those purchases is over $76,000 per coin. If you do the math, that means they have deployed over $54 billion into this asset.
It's massive.
At that scale, this isn't just a corporate treasury casually holding some reserves. It's mutated into something entirely different, hasn't it?
What's fascinating here is that it has completely transformed. It is no longer an enterprise software company in any meaningful economic sense.
Right.
It operates, for all intents and purposes, as a highly leveraged, publicly traded hedge fund, operating under the regulatory guise of an operating company. Whatever revenues they generate from their legacy software business are effectively rounding errors compared to the massive, multi-billion-dollar daily swings in their balance sheet dictated entirely by the price volatility of their digital asset holdings.
Unbelievable.
And the financial mechanism they utilized to build this unprecedented stockpile is truly fascinating from a corporate finance perspective. But it is also a textbook example of a classic, potentially fatal leverage trap. During the massive bull markets of 2024 and 2025, their acquisition strategy looked like an act of pure financial genius.
Right, because they were exploiting a massive inefficiency in how the traditional market values access to crypto. Walk us through how they use their own stock as a weapon to accumulate more coins.
It all comes down to the market cap to net asset value ratio, or the MNAV. Because traditional equity investors were absolutely desperate for regulated, easily accessible exposure to the digital asset boom. Without having to navigate crypto exchanges or manage their own private keys, they were willing to pay a massive premium for Strategy's stock.
So the stock was detached from the value of the coins.
Right. Strategy's stock traded at a substantial premium to the actual underlying liquidation value of the coins it held in its treasury.
Let me make sure I have this straight. The MNAV was well above 1.0. So conceptually, people were eagerly paying $1.50 in the stock market to get exposure to $1 worth of the underlying digital asset, purely for the convenience and regulatory comfort of holding it in a standard Fidelity or Charles Schwab brokerage account.
Exactly. The convenience premium was massive,
Hmm.
and the executive team at Strategy recognized this and exploited that premium brilliantly. Their playbook was simple but aggressive.
What did they do?
They would authorize the issuance of new shares of their own company stock, selling them into the open market at that inflated $1.50 premium. They would take the billions of dollars of fresh fiat capital raised from those stock sales, turn around, and use it to buy more of the underlying digital asset at the $1 spot price.
That's a money printing machine.
It was an incredibly powerful, self-sustaining flywheel that mathematically constantly increased the amount of the digital asset held per individual share of stock. The shareholders were happy because the stash was growing, and the company was happy because their treasury was expanding.
Until it stopped.
Exactly. As any veteran of Wall Street knows, leverage is a ruthless double-edged sword. It amplifies your gains on the way up, but it accelerates your destruction on the way down. By February 2026, as the macroeconomic wind shifted and the price of the digital asset violently crashed below their $76,000 average cost basis, that entire $54 billion massive treasury went deeply underwater.
And here is the terrifying part of that flywheel. When the underlying asset goes underwater, the entire psychology of the traditional market instantly inverts. That massive MNAV premium that fueled their buying spree vanished overnight.
It did.
And it immediately turned into a steep discount. According to the early 2026 metrics, that ratio collapsed down to roughly 0.87x. Meaning, the public equity market was now valuing the entire company at significantly less than the raw theoretical liquidation value of the coins they held.
Yes.
And when your stock trades at a severe discount to your underlying assets, the game is over. You can no longer issue new equity to buy more coins without massively immediately destroying existing shareholder value. The flywheel doesn't just slow down, it breaks completely.
And that breakage raises a critically important question about corporate solvency versus liquidity during a bear market. It's vital to remember that the company didn't just use free equity to buy these assets. They aggressively utilized massive amounts of complex corporate debt.
Right.
To fuel their buying addiction, they issued billions in convertible senior notes, and they issued perpetual preferred shares. And unlike equity, which can just sit there and suffer a lower valuation, those debt instruments come with strict covenants and fixed, unyielding cash obligations.
The real bills to pay.
Exactly. For instance, some of their preferred shares carry a variable dividend rate that, due to the higher interest rate environment, was sitting at a punishing 11.25%. That is an enormous, suffocating cost of capital.
So let's paint this picture clearly. They're sitting on a massive $50+ billion pile of a highly volatile digital asset that produces absolutely zero yield. It pays no dividends. It generates no cash flow.
None.
Yet simultaneously, they have to somehow generate hundreds of millions of dollars in real hard fiat currency every single year just to service the massive debt they took on to buy the non-yielding asset in the first place.
Precisely. It's an incredibly precarious position to navigate during an extended bear market. The pressure is immense. In fact, their financial filings revealed they actually had to carve out and set aside a massive $1.44 billion cash reserve solely to guarantee to their creditors that they could service this debt and pay those crippling dividends for the upcoming 12-month period.
It's like watching a financial high-wire act. The tightrope walk looks brilliant, almost effortless, when the macroeconomic wind is at your back, pushing you forward and keeping the momentum going.
Yeah.
But the absolute moment the wind changes direction, when you face a sudden 20 or 30% drop in the underlying collateral price, that massive leverage and the looming threat of equity dilution threatens to turn into a complete corporate death spiral.
Yes.
If their cash reserves ever dry up, and they are ever forced by their creditors to actually sell off chunks of their digital treasury just to cover their debt obligations, they would be dumping massive supply onto the open market, actively crushing the very price of the asset they are desperately trying to support.
What's truly fascinating here, if we take a step back and look at the philosophical arc of this technology, is the profound irony of the current situation.
What do you mean?
The foundational genesis premise of this entire digital asset class was decentralization. It was built around the idea of an asset that lives on a globally distributed ledger, completely free from central points of failure, free from corporate mismanagement, and immune to the risks of traditional finance.
The core ethos.
Yes. Yet through these massive treasury accumulations, Wall Street has effectively re-centralized the decentralized. Hundreds of thousands of these assets are now aggressively concentrated onto single, highly levered corporate balance sheets. In doing so, these companies have explicitly introduced traditional corporate default risk, credit downgrade risk, and dividend yield pressures into an ecosystem that was explicitly cryptographically designed to bypass them.
So true.
If a traditional corporate auditor looks at the books, or if a debt covenant is breached and forces a liquidation, the blockchain's beautiful decentralized cryptography offers absolutely zero protection against the resulting market dump.
And as if the internal corporate debt wasn't enough of a headache, there's also an external structural threat looming over them from the traditional index providers.
The MSCI issue.
Yes. Over the course of 2026, we started seeing serious reports surface that major index providers, like MSCI, might implement new rule changes. These rules would explicitly target and exclude these specialized digital asset treasury companies from their mainstream traditional equities indices, arguing that they no longer represent the sector they claim to operate in.
It's huge risk.
If a behemoth-like strategy officially gets booted from the MSCI indices, the collateral damage would be immense. The immediate forced passive outflows from every single ETF, mutual fund, and pension fund that automatically tracks those indices would be catastrophic for the stock price. It's just another massive layer of traditional financial entanglement that poses a severe risk to the asset's overall price stability.
It's a stark reminder of the Faustian bargain the industry made. It powerfully demonstrates that you simply cannot adopt the incredibly lucrative infrastructure of traditional finance, the massive liquidity of the ETFs, the access to the public equity markets, the cheap leverage of the corporate debt markets.
Right.
You cannot adopt all that without fully adopting its inherent vulnerabilities and strict rules. You are playing by Wall Street's rules now. And Wall Street's rules, its index rebalancings, its margin calls, its debt covenants, are entirely indifferent to the philosophical promises or the mathematical purity of a digital currency.
Now, speaking of playing by new, unprecedented rules, we have to scale up our view even further. We've talked about hedge funds, we've talked about massive corporations. Now we have to look at the ultimate macroeconomic player, the sovereign state.
Yes.
Before we dive into this next analysis, I want to make it explicitly 100% clear to you, the listener, that we are approaching and analyzing this topic purely from a macroeconomic, structural, and monetary policy perspective.
Absolutely.
The data we are looking at details specific policy actions taken by the United States government during the 2025 and 2026 timeline. We are not here to endorse, and we're not here to criticize any of the political actors, the administrations, or the ideologies involved. Our sole objective on this show is to impartially, objectively break down what these sovereign policy shifts actually mean for the mechanics of the financial markets, treating these government actions strictly as macroeconomic variables on a spreadsheet.
That is absolutely the correct and only analytical approach to take here, because from a purely economic structural standpoint, the formal establishment of the United States Strategic Bitcoin Reserve, the SBR, in March of 2025 was an undeniable watershed moment in global monetary history.
It really was.
It was a massive paradigm shift. The SBR was initiated via an executive order that completely reversed decades of standard operating procedure. It directed the U.S. Treasury to take the substantial troves of digital assets that the government had accumulated over the years through various Department of Justice seizures and law enforcement actions, and instead of routinely auctioning them off for cash to fund government operations as they historically did, the Treasury was ordered to stockpile them,
To hold them.
to lock them away and manage them formally as a strategic long-term national reserve asset, theoretically sitting alongside the nation's gold reserves and foreign currency holdings.
The underlying theory behind the policy was to establish a unique, modern store of value for the nation's balance sheet, operating under the assumption that the asset's cryptographically fixed supply cap made it akin to a digital version of Fort Knox.
Right.
But here is where the rubber meets the road, and where everything we meticulously unpacked in Part 1 comes crashing back into the macroeconomic reality. The macro winds shifted incredibly hard in early 2026.
They certainly did.
We saw aggressive, hawkish pivots from the Federal Reserve as inflation metrics proved stubborn. The broad market expectations for rapid liquidity expansion and easy money were completely removed from the table. And as a result, global risk assets plummeted. If we take your digital alpha theory, the statistical reality that this asset acts as a pro-cyclical volatility multiplier, and we apply that exact mathematical reality to the balance sheet of a sovereign nation, the economic implications are absolutely wild.
If we connect this to the bigger picture of sovereign fiscal health, the math becomes incredibly unforgiving. We have already established through rigorous quantile regression data that this specific asset has a crash beta of 1.25.
Right.
It mathematically falls 25% faster and harder than traditional equities during a liquidity panic. Now, I want you to imagine the structural implications of integrating a massive stockpile of a 1.25 beta asset into the core of a sovereign national reserve balance sheet. What is the fundamental historical purpose of a national reserve?
Stabilization.
Exactly. Whether a nation holds physical gold bullion or U.S. treasuries or foreign fiat currencies, the primary goal of that reserve is to provide rock-solid stabilization and liquidity during severe economic crises. But consider what happens under this new paradigm. If the U.S. economy enters a severe recession, traditional equity markets will fail, corporate profits will plummet, unemployment will likely rise, and consequently, national tax revenues will drop off a cliff.
Exactly. And right at the exact desperate moment, the federal government needs to lean heavily on its reserves the most, because standard tax revenues are drying up and stimulus might be needed. The value of that newly established strategic reserve would be crashing by an even greater magnitude than the broader stock market.
Yes.
It's the definition of pro-cyclical sovereign risk. You are essentially taking a massive hypervolatile multiplier and strapping it directly to the national balance sheet. Based on the data we saw in early 2026, it completely fails the fundamental macroeconomic purpose of a reserve asset, which is supposed to be countercyclical, providing a buoy when everything else is sinking.
Exactly. When analyzed through the lens of traditional monetary policy, a reserve composed of this asset behaves much more like a highly aggressive sovereign venture capital fund than a reliable stabilization tool. It introduces massive, unpredictable variance into the national ledger.
Wow.
And while the mainstream financial media focused heavily on the headlines generated by the SBR, a potentially much more dangerous, deeply systemic macroeconomic risk was quietly brewing in the underlying unglamorous plumbing of the digital economy: stablecoins.
Stablecoins.
Stablecoins are the lifeblood, the actual functioning liquidity conduits that allow this entire global 24/7 casino to operate. And the empirical data regarding the balance sheet of the single largest stablecoin issuer in the space is highly, highly concerning from a systemic risk perspective.
Let's talk about the numbers on that.
As of the early 2026 data, this single entity is holding roughly $184 billion in outstanding liabilities. That means there are $184 billion worth of their digital tokens circulating around the global crypto economy. And for every single one of those tokens, the company promises it can seamlessly redeem it for one actual physical U.S. dollar on demand.
Okay.
However, their publicly stated equity buffer, the cushion designed to absorb any losses on the assets they hold in reserve to back those tokens, is only about $6.3 billion.
$6.3 billion to cover $184 billion. That is a razor-thin margin of error.
It is.
If the value of the underlying assets they hold in their treasury reserve, whether that's commercial paper, specific bonds, or even just slightly mismanaged duration risk on treasuries dropped by even a few percentage points, that entire $6.3 billion equity buffer is completely wiped out. the stablecoin immediately becomes under-collateralized.
Right.
And if the market catches wind of that, it risks breaking the buck, breaking that sacred one-to-one peg with the US dollar. We've seen minor stablecoins depeg before, and it causes absolute, unmitigated chaos across the entire digital asset trading space as everyone scrambles for the exit simultaneously.
Yeah.
And yet, what is truly mind-bending to me is that instead of pulling back and demanding higher capitalization, traditional finance is actually integrating these highly leveraged stablecoins even deeper into the core system. We saw the SEC issue new guidance that allows traditional broker-dealers a mere 2% capital haircut relief for holding eligible stablecoins.
Unbelievable.
They are actively making it cheaper and significantly easier from a regulatory capital perspective for traditional systemically important brokers to hold the specific digital risk directly on their own balance sheets.
The integration is indeed accelerating at a breakneck pace, blurring the lines entirely between the crypto shadow banking system and traditional regulated finance. We simultaneously saw the high-profile launch of a $17 billion stablecoin-ready money market ETF, further cementing these digital tokens as acceptable collateral in traditional yield-bearing instruments.
Right.
But the speculation and extrapolation here must look beyond domestic policy and focus on what is happening on a global scale. We are now seeing massive, Tier 1 traditional global banks, institutions like BNP Paribas, actively experimenting with and moving toward creating their own native G7-pegged stablecoins on public blockchains.
Which changes everything.
It does. If major global banks begin aggressively issuing their own tokenized fiat currencies, utilizing blockchain rails rather than traditional banking ledgers, it could fundamentally rewire the entire plumbing of the global financial system. It creates the infrastructure for instant, 24/7 cross-border settlement, completely bypassing the slow, expensive, traditional correspondent banking networks like SWIFT. The geopolitical and macroeconomic implications of that shift are profound. It drastically alters how massive amounts of capital flows across borders and potentially moves that capital velocity completely outside the immediate real-time purview of central bank monitoring and traditional sanction enforcement mechanisms.
It's an absolute paradigm shift. The very plumbing of global finance, the pipes that move the money around the world, are being dug up and rebuilt in real time while the water is still flowing through them.
Perfectly said.
But while all this massive institutional maneuvering and sovereign policy debate is happening loudly at the surface level, there is a massive, completely silent force operating in the deep, dark depths underneath it all. And to understand this unseen gravity, we have to transition away from the stock market tickers and look directly at the raw, on-chain, blockchain data. We have to examine what is known in the space as the ancient supply. So what does this all mean? What exactly is ancient supply, and why is it suddenly the most important metric nobody's talking about?
One of the unique features of a public blockchain is radical transparency. In on-chain analytics, we don't have to guess about supply. We can track every single transaction perfectly and see exactly how long it has been since a specific coin was last moved between wallets.
Okay.
When analysts use the term ancient supply, they are referring to coins that have sat completely dormant, entirely untouched, without moving a single time for 10 full years or more. These represent the ultimate unwavering long-term holders.
Wow, 10 years.
And what our data showed is that a historic, unprecedented structural shift occurred within this specific demographic following the highly anticipated 2024 halving event, which programmatically reduced the amount of new coins that are minted by the network every single day.
Right. The network code dictates that the reward for mining a block drops in half periodically. So post-2024, only about 450 brand new coins are actually being created and introduced to the market each day.
Correct.
But the on-chain data shows something incredible. The amount of existing coins that are quietly aging into that prestigious 10-year unmoved category is averaging about 566 coins per day. So for the first time in the entire history of the asset, the amount of coins officially turning ancient and going dark is actually outpacing the creation of newly minted coins.
Yes.
The actual available floating supply of the asset is mathematically shrinking every single day.
It is a profound, mathematically guaranteed supply shock that is slowly tightening its grip on the market. It's important to contextualize exactly who owns this massive trove of ancient supply.
Who is it?
It is widely estimated by Forensic Chain Analysis that roughly 1/3 of all these 10-year dormant coins are held in the original wallets controlled by the anonymous creator of the network, Satoshi Nakamoto.
Satoshi.
But the remaining 2/3, which represents a staggering amount of wealth, represent the earliest adopters. These are individuals who have stubbornly refused to sell through multiple agonizing 80% drawdowns
Right.
and who have refused to take profits during massive euphoric bull runs.
True, diamond hands.
They represent an incredible high-conviction holding base that seemingly operates completely detached from traditional market psychology.
Yeah.
However, the behavioral data that emerged from the heat maps in late 2025 and early 2026 revealed a startling, highly uncharacteristic anomaly in this cohort.
Normally, when you look at these charts, this ancient supply just steadily, reliably grows. It's the bedrock of the market. But the on-chain heat maps during the peak of the market showed a massive, undeniable spike in long-term holders, people who had held through thick and thin for 5, 7, even 10 full years, finally waking up, moving their coins, and selling them onto the exchanges during that late 2025 to early 2026 window. After a decade of holding, the conviction finally cracked. The old guard started cashing out, but they weren't just throwing their coins into a void. While the retail investors were panicking and some of these older hands were finally distributing their long-held coins, the whales, the massive, deeply capitalized wallets holding huge concentrations of wealth, were stepping in and accumulating incredibly aggressively.
They were.
The data shows that in the absolute midst of the brutal February crash, while the ETFs were bleeding and the hedge funds were unwinding, these silent whales stepped in and bought nearly 67,000 coins in a single day. That is an astonishing, almost unfathomable amount of capital stepping directly into the path of a collapsing market.
If we connect this to the bigger picture, we can clearly visualize exactly what is happening in the hidden architecture of the market microstructure. The market has transformed into a brutal, invisible battleground.
Battleground.
Yes. On one side of the ledger, you have the highly visible institutional arbitrageurs, the hedge funds unwinding their basis trades, and the emotionless risk parity algorithms automatically dumping massive tranches of spot assets via the ETF redemption process. This side is creating immense, relentless downward price velocity. On the exact opposite side, lurking in the depths, you have these massive silent whales. These could be ultra-high net worth individuals, proxies for sovereign wealth funds, or private, unlisted syndicates, who are looking at the exact same data and treating this algorithmic Wall Street selling panic as a generational liquidity event. They are quietly and methodically absorbing the massive floating supply that is being discarded by Wall Street, moving it off the exchanges and locking it away into deep cold storage.
So, what does this all mean for the future of the asset? We have Wall Street aggressively dumping millions of dollars worth because their internal risk spreadsheets mandated it, and simultaneously we have these massive silent whales absorbing tens of thousands of those coins into cold storage, effectively removing them from the liquid tradable market entirely.
Yes.
It feels like the fundamental soul of the asset is being violently torn in two completely different directions by two entirely different philosophies of capital.
It means the extreme, jarring volatility that we witnessed in early 2026 is highly likely not an isolated anomaly. It is the newly established standard operating procedure for this asset class. When the available liquid floating supply of an asset continuously shrinks because it is being aggressively locked up by whales and ancient holders refusing to sell, the remaining order books become incredibly thin. Therefore, any sudden macro-driven shift in institutional demand, like a massive coordinated ETF outflow triggered by a tech stock margin call, will inevitably cause violent, heavily outsized price swings. The market currently lacks the deep, resilient, robust liquidity required to smoothly absorb Wall Street's massive momentum trading without experiencing severe, chaotic price dislocations.
That brings us to a perfect point to synthesize this massive, incredibly dense journey we've taken today. We set out at the beginning of this hour to understand the brutal stress test of early 2026. And looking at the totality of the data, it paints a crystal clear, if somewhat sobering picture.
It certainly does.
The asset we've been analyzing is unequivocally not digital gold. It does not provide a protective shield when the traditional equities markets catch fire. Instead, it operates as a hypersensitive, high-beta, pro-cyclical risk asset, what we are firmly defining as a digital alpha. It has been entirely irreversibly integrated into the traditional financial system. Wall Street's relentless ETF machine brought incredible, unprecedented volumes of liquidity to the space, yes, but it also brought Wall Street's ruthless, mathematically cold, algorithmic reflexes.
Yes.
When U.S. Treasury yields shift favorably, or when traditional AI tech stocks face sudden margin calls, this supposedly decentralized, independent asset is now routinely liquidated simply to balance the fiat books of centralized finance.
And as we've detailed, This deep integration carries profound, potentially systemic risks that extend far beyond the crypto echo chamber. We see it clearly in the corporate proxy companies running massive, highly precarious leverage traps, threatening equity dilution death spirals just to service the massive debt burdens on their digital treasuries.
Right.
We see it in the shifting macroeconomic policies, where sovereign nations are proposing to add a mathematically proven 1.25 crash beta asset to their core macroeconomic reserves, introducing dangerous pro-cyclical risk exactly at the moment when national stability is needed most.
And the stablecoins.
And we see it in the underlying critical plumbing of the entire system, where privately issued stablecoins operating with terrifyingly razor-thin equity buffers are becoming deeply legally intertwined with traditional broker-dealers and massive systemically important money market funds.
So as we wrap up, I want to bring this directly back to you, our listener. If you're sitting at home right now looking at your retirement portfolio and you've been treating this asset class like a modern digital mattress to stuff your savings into during uncertain macroeconomic times, you need to reevaluate your portfolio construction immediately.
Absolutely.
If you are stubbornly holding high beta digital assets with the expectation of safety during a traditional stock market crash, the hard, empirical, undeniable data from 2026 suggests a terrifying reality. You aren't holding a protective shield. You're standing directly under a falling piano.
The market has undeniably matured, but that very maturity demands a much more sophisticated, ruthlessly analytical approach to risk management. You simply cannot rely on the outdated ideological internet narratives of 2018 to successfully navigate the hyper-financialized algorithmic realities of 2026.
Exactly. And I want to leave you with one final, lingering existential question to ponder on your own time as we close out. We've seen clearly today that institutional algorithms and massive ETF flows now entirely dominate the day-to-day trading velocity and price discovery.
Yes.
At the exact same time, the long-term ancient holders and massive silent whales are continuously absorbing and locking away the actual underlying supply of the asset into cold storage. If this dual trend continues to its logical mathematical extreme, what happens to the core original promise of this entire technology?
That is the big question.
It was initially designed, cryptographically, to be a decentralized, peer-to-peer, frictionless currency for the everyday world. But if the entire available supply ultimately ends up locked away in the vaults of Wall Street risk models, sovereign nation-states, and heavily indebted corporate treasuries, does it completely lose its intended utility?
Right.
Does the asset become so heavily financially engineered, so deeply embedded in the exact centralized system it was initially meant to disrupt, that it ceases to be a currency at all and just becomes another sterile, hyper-volatile Wall Street derivative?
That is the ultimate existential question facing the entire ecosystem moving forward, and the answer will likely define the next decade of global finance.
Thank you so much for joining us and taking this deep dive today. We know it was an immense amount of complex data to process, but our primary goal is always to cut through the deafening noise, entirely bypass the internet hype, and find the actual data-driven signal beneath it all. Until next time, stay curious and stay informed.